Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Sebastian. It's excellent to have you on our podcast show.
Good to be with you, Bilal.
Now, before we go into the heart of our conversation, I did want to ask you something about your origin story. Where did you go to university? What did you study? And was it inevitable you'd end up in academia, writing, and finance?
Well, when I was about 16, I was asked by my school to fill in some sort of questionnaire, about kind of what I wanted to do in the future. And it was supposed to help me think about what career I might go into. And my wife, who is a distinguished journalist, was told at this point when she did a similar thing that she would become a librarian. So that was wrong. But in my case, I wrote down I wanted to do journalism and writing, and that's exactly what I turned out to do. I went to Oxford, read history, edited one of the student magazines, went straight from there to the Economist magazine as an intern, and then stayed on the staff. And so it was a pretty I had in my head, being a sort of restless person, I was always thinking about, well, maybe I should have tried something different. But actually, what I did, the revealed preference, was precisely what I had predicted at 16.
No, that's excellent. And you've written some really, really good books. I mean, one of the books I've read, and many of our other guests have actually recommended themselves, is your book, More Money Than God, Hedge Funds and the Making of New Elite, which is one of the definitive books about the hedge funds. And more recently, you've written a book called The Power Law, Venture Capital and the Making of the New Future, which I think also will become one of the definitive books on the venture capital industry. And I really wanted to focus more on this book because I think that, at least in recent years, the prevalence of news stories around venture capital seems to have gone up dramatically, and you hear a lot more about VC firms than before. So it seems like there's something in the air about VC. So maybe we can start with that. I mean, why have VCs come into the news, at least in the financial news, so much in the last 5-6 years?
Well, the period from the financial crisis in 2008 through to COVID, the trade was long tech, right? I mean, technology stocks dominated pretty much all the value creation in the S&P 500, and venture went on a wild tear and generated amazing returns. Any US college endowment that decided to allocate overweight to venture tended to be, outperformed by a lot. And so I think that's why it's been so prevalent in the news. It's just been an amazing bull market, which of course then corrected in 2022, 2023. So we're paying the price for that wild ride. But to a first, like on a financial surface level, that's the answer. A deeper answer would be that the world economy is moving more and more towards intangible capital and, away from stuff you can drop on your foot, hard plant machinery, etc., to ideas, innovation in processes, and software, IP, etc. And those kinds of research-created forms of capital, it turns out, are best created through iterative experiments run through startups backed by venture capitalists. And so I think just as the leverage buyout became the go-to financial mechanism of the 1980s because you had all these sort of slightly bloated US corporates that needed to re-engineer themselves in the face of the Japanese competitive threat. And so you had this sort of leverage buyout, M&A boom, and barbarians at the gate and all that stuff. I'd say that for the form of capitalism that we entered around, post GFC in 2008, the go-to mechanism was venture capital. And that's what I sort of captured in my book.
And is there a definition of venture capital?
Yeah, that's a great question. I mean, I think of it as, equity stakes in startups that are going to be tech focused. So I don't think one shouldn't count, friends and family investments in restaurants, startups, right? these are ambitious tech-driven startups that hope to have a parallel outcome. In other words, they can multiply the investor's capital by 10x or more.
Yeah, no, that makes sense. And in your book, you talk about the implicit belief system of venture capital firms, which I found quite interesting. Could you describe what the beliefs are of venture capital firms?
Yeah, maybe that was so implicit that I didn't quite get it myself. But I mean, I guess I wrote about the successive sort of waves of intellectual innovation that drove the methodology of venture capital partnerships. So right at the beginning, a pretty obvious one was just to understand that one big success, if it goes 10x or more, is obviously going to make up for a lot of failures. So you should lean into risk, be okay with the idea that in your portfolio, 7 out of 10 bets, 8 out of 10 bets may be losses, because it's the right-hand tail, which is going to drive the ultimate portfolio performance. So that's one insight, which I think was grasped by Arthur Rock, the father of venture capital in the 1960s. And then, after that, there was the idea that this should only be an equity investment, not a debt investment. It's obvious now, but it wasn't obvious in the 60s when the government was providing matching debt to venture firms. Then there was the idea that you can't exit these positions because they're illiquid. So what you do is you manage risk not by the ability to sell out, but by the ability to go on the board and exercise control. So you tell the entrepreneur if you think he or she is going to drive the startup off a cliff, and you try to persuade them not to do that. And so risk management takes the form of being hands-on. And then there is this stage-by-stage investment idea, right? So obviously with a super early startup, it's just an idea. There is no prototype perhaps even, or if there's a prototype, there's no customers yet. And the earlier you are in the company journey, the higher the probability that the thing will fail. So it makes sense not to finance kind of the first 3 years of growth upfront, because there's a high risk that you'll never get your money back. So therefore you finance stage by stage. You say, okay, here's some money to get you through the first 9 months or something, and come back to me and let's see what progress you've made. And if it looks positive, then I'll sort of, back you in your search for the next tranche of capital. And that turns out to be good, not merely for the investor, because it gets some of the white hot risks off the table before you write a big check. It's also actually good for the entrepreneur, because obviously the entrepreneur has to give away more equity for each dollar received of investment if it's really early and it's really risky. By the time the startup has a bit of traction, the valuation has gone up, which means that the entrepreneur can raise the equivalent number of dollars whilst giving away less equity.
Yeah, that makes sense. And there was also another element of making a change to the world as well, this kind of disruption idea that, VC firms invest in companies that disrupt the status quo and the world ends up in a better place, that there's this implicit technological utopianism, belief ideology behind this.
I see what you mean. Yes. I mean, there is that. I think it wasn't always utopian. If you go back to the earlier part of the history I described in my book in the 60s, 70s, 80s, it was a more sort of sober engineering culture. Imagine those people with, neatly parted hair and sort of, pens popping out of their white shirt pocket. I think it was a bit more like that. I mean, not everybody was like that, but there was an element of that. And I think the utopianism came in the 90s when you have the tech boom. The internet boom specifically. And at that point, returns just became so wild. And also there was a sort of self-fulfilling nature of these growth stories. So if you got a huge amount of traction early on with a .com startup, that boosted your brand, the brand boosted more traffic, the more traffic boosted your brand. So there was a lot of mileage to be had just from hype and just getting a marketing jump. And so then the utopianism was partly driven by the objective fact that you could get these startups that scaled incredibly because of the way the internet was growing. And at the same time, the subjective reality that if you could persuade people that you're about to grow like that, then you might grow like that. And so both those things drove the utopian hype.
And before we go into some of the history of VC firms and how the industry looks today, one thing that everything keeps coming back to Silicon Valley. This one location, this one little part of California, which is the center of VC, not necessarily the center of tech, because as you rightly point out in your book, tech firms are dispersed across the US and across the world. Seattle, has Microsoft and so on, and there's lots of tech firms all over the world. What is it about Silicon Valley that makes it so relevant for VC?
Yeah, I think that Silicon Valley dominance, is fading a bit. There is geographical dispersion now, more than there used to be. And we can come back to that. But for the bulk of this history that I cover, from the 60s to, let's say, 10 years ago, Silicon Valley was just overwhelmingly dominant. And I think that was because it had it had figured out this formula of risk-friendly venture capital. And the venture capitalists who practiced this formula were very, very good at connecting startup founders with all the inputs they needed to get a company off the ground. So if you imagine the thought experiment of a engineer who has a great idea, and this engineer is working halfway up the research department of some bigger company, and the great idea is squashed by the boss of the engineering department because there's a sort of innovator's dilemma problem, and the company doesn't want to do something which is new and good, but threatening to the existing product. So now the engineer wants to leave. And in an environment with no easy venture capital access, the engineer might want to leave, but might not actually do it because it's kind of scary to leave your job and all that. But in a venture capital rich ecosystem like Silicon Valley, the engineer is watching, his daughter or son playing soccer or something on that weekend, and the parent next to him is actually a VC, and they get talking. And the VC says, well, if you've got this idea and you're frustrated, you just start a company. And the engineer says, yeah, but I don't know how to do that. And the VC says, well, I do it all day. I mean, that's what I do. I'll help you. But I don't have capital. Yeah, well, I'll give you the capital. But I don't know how to find 5 engineers to hire to help me to build a prototype. You know what? I've got a Rolodex with like 55 engineers, and you can just pick the 5 that you like. Oh, but how do you get incorporated? I need a lawyer. Yeah, I know lots of lawyers. Don't worry. But then how do I, just et cetera. Every single kind of obstacle that an entrepreneur might be nervous about before taking that scary leap from a secure job to a startup, all of those can be kind of softened by an experienced VC who will show you the way. And I think that's what you had in Silicon Valley, this super active super connectors who were the VCs.
No, that's great. Yeah, and that does tell us something about the value add of venture capital firms to entrepreneurs, and they aren't necessarily parasitic in the way that some people may imagine them to be. Now, I'd like to go into the history a bit. You did mention Arthur Rock. What's the significance of Arthur Rock? You implied that he was the founder of venture capital.
Yeah. In 1957, Arthur Rock was a broker on Wall Street, a sort of, somebody who raised money for private companies. And he got this invitation to come and see a group of, at the time, 7 engineers who wanted to quit a fledgling semiconductor company because the boss, Shockley, was both brilliant and terrible to work for. And he flew out and he backed them, and that became Fairchild Semiconductor, which was then the sort of parent company for Intel. And you can trace a huge amount of Silicon Valley's sort of hardware lineage back to that group that founded Fairchild Semiconductor. And Arthur Rock, who did that deal, then moved out to the West Coast. And in 1961, he formed his own equity vehicle to do venture stakes. And I see him as the sort of father of the whole sector, because the other candidates for that role got something wrong. So there was Arthur Rock's competitor in Boston, George Dorio, who founded American Research and Development, and that was a publicly listed technology investment vehicle. And public listing meant you got ensnared by all kinds of regulation. You couldn't use high-powered incentives to get your investing team fired up. And so whereas Arthur Rock made an insane multiple for his backers, ARD did not manage the same. And people who worked at American Research and Development got so frustrated with the whole setup where they were not being paid for success that they kind of spun out and did companies like Greylock and Cambridge, I guess it's Cambridge River, CRV, Cambridge River Ventures. So Rock was the guy who got it right in terms of an equity-only, time-limited fund focused aggressively on high multiple potential and not being frightened of losing money on many of the bets. When I went to see some of the early Boston players who had been active in the 70s in Boston, what was striking was that they would say things like, I had a great career, I did 40 investments in my career, I didn't lose money on a single one. And if you said that on the West Coast, you would be laughed at for being insufficiently risk-friendly. Of course, you should lose money on the majority of your investments if you're a West Coast red-blooded venture capitalist. And it was that kind of, forward-leaning, risk-friendly, equity-only style that Arthur Rock really invented.
And what was the name of Rock's firm? Did he create a firm?
He created Davis and Rock with a fellow investor called Tommy Davis. And Tommy Davis went on to found another partnership later called Mayfield, which was quite a big deal in the 1980s. And Rock and Mayfield, Rock and Davis did not get on. Rock was, I think, pretty prickly character, actually. They ran their fund for sort of the planned 7 years, and then they went their separate ways. And after it disbanded in the late 60s, the results became public, which inspired a sort of huge gold rush of competitors who thought, okay, here's the way to make money. And lots of copycat operations like Hambrecht and Quist, which became famous later as a kind of tech investment bank, began as a venture operation inspired by the Davis and Rock example.
And so, Rock kind of created the sector, you could say. And what was the next important stage in the evolution of the industry, would you say?
Well, I think 1972 is the next great watershed when both Sequoia Capital and Kleiner Perkins got started. And it was this pair of companies that began this idea of both hands-on investing, which I mentioned earlier, to control the risk, and then also the stage-by-stage investments. In fact, Tom Perkins would speak about the white-hot risks that had to be eliminated before he wrote the second check. And that proved to be a great formula. He did the Genentech investment, the first successful biotechnology company, as well as Tandem Computers, which was a hugely successful kind of hardware play in the 70s.
Okay, great. So I guess the second stage, I suppose, established how a VC firm should invest, the stage by stage, and the hands-on approach in terms of board control. And Sequoia is still around today. It's very famous. Kleiner Perkins as well. So they've lasted quite a long time as well. And then after that, I mean, what happened, say, in the 80s and the 90s? Because obviously the 80s was a real go-go period for finance as a whole, Wall Street and so on, LBOs you talked about earlier, with Barbarians at the Gate and Michael Milken, I suppose, as characters. How did that change the industry?
So in the venture world, the timing of the cycles was slightly different. There was this huge bull market from around 1977 to 1983. When enormous amounts of capital flowed in. I think that was driven partly by the example effect of Apple going public in 1980, Genentech going public in 1980. And secondly, it was driven by tax and regulatory changes. There was a redefinition of what was called the prudent man rule, which had prevented pension funds from investing in venture. And prudence was sort of redefined at the end of the 70s to allow venture investments. And so that unlocked a whole bunch of capital. And then also capital gains taxes were reduced. And that encouraged people to put money into venture. So you had this big sort of, go period between 77 and 83. Then there was a bit of a downturn, and then it picked up again in the kind of 1990-ish period with the advent of the internet. I'd say the big watershed moment equivalent to 1972, which took place in the 1980s, was 1983, the founding of Accel Capital, because Accel, which is still around today, is still quite a big player, was innovative in a couple of senses. First, it was the first venture partnership to deliberately specialize in a couple of technological areas. So it said it's going to do software, it's going to do telecoms. And that was novel because before, the venture space had been so small that everybody did everything. If you had specialized, you wouldn't have had enough deals to do. But by the 80s, because of that boom I was talking about between 77 and 83, enough new money had come into the space that the problem had kind of reversed itself. It wasn't that there were not enough deals, it was that there were lots of people chasing deals, and you had to differentiate yourself in brand terms as a newcomer in the investment world. And the way they differentiated themselves was to say, we're specialized, we're not just happy-go-lucky, know a little bit about a lot of things. No, we're really deep here. And they hired domain experts. They ran sort of specialist conferences at Stanford University around telecoms. They put their flag deliberately in these two areas of technology and said, if you care about those areas, come to us. And they also had this idea about the prepared mind, which in fact stuck around in the industry and became quite influential, which was the notion that when the entrepreneur walks into the office, you ought to know 90% of what they're going to say before they say it, because you're so sort of deep in the sector that you've specialized in that all of the new ideas for new companies are kind of stuff you've heard before. And they would reinforce prepared mind by doing these kind of almost management consulting type of exercises where they would think, they would do a sort of scenario planning exercise and say, okay, in the next 12 months, what types of new company need to be created given where technology is? And secondly, given those types of company that we foresee happening, what is the profile of the entrepreneur who would do well at that? So if it was a particular kind of, router technology, it would be somebody who had graduated from one of the recognized router incumbents. So somebody who came out of Unger and Bass, for example, which was a big deal at the time, or possibly somebody who's come out of a certain PhD program or whatever it is. And that idea of having a prepared mind sort of offset the, rushing from one deal to the next and just kind of going with your gut, which was a bit how one might have defined the cottage industry phase of the business.
So in some senses, it was professionalizing the industry in many ways, or making it more scientific.
Correct. Absolutely.
Yeah. And you mentioned Stanford, and of course, Stanford and universities loom quite large in the startup space, and hence, by extension, the VC space. What role do you think the universities played? Both East and West Coast.
So when I began doing my research, I would go out to Silicon Valley, and people would sort of, say, "Well, I'll tell you a secret." And I get very excited, and I say, "Yeah, what's the secret?" And they would say, the reason why Silicon Valley is so dominant is ... And they would give me their theory. And one of the theories was Silicon Valley is really Stanford Valley. It's something special about Stanford. But if you think about the historical story here, that turns out to be nonsense, because MIT was a much stronger engineering university until probably as late as 2000, right? I mean, Stanford was good, but it was by no means as good as MIT. And if you want to throw Berkeley into the mix, well, we can throw Harvard into the mix for the Boston ecosystem. And clearly they had the edge in Boston in terms of sort of academic tech research and excellence. And by the way, the same is true of the defense contracting theory of Silicon Valley's growth. It's true that there were defense contracts which helped the early semiconductor makers, but there were more defense contracts going to Boston. So that's not the reason why Silicon Valley became Silicon Valley. The reason is, as I indicated earlier, the reason is that, the venture capital themselves, they were more risk-friendly on the West Coast. But what was Stanford's role? What I would say is that, clearly it's good to have a cutting edge engineering and sort of science academic hub as part of your tech ecosystem, because people can spin out of that and take a break from their PhD or whatever and do a company. And you can think of companies like Google that started precisely like that. And I think Stanford has evolved into being a place that's not only fantastic at engineering, but also has a culture where it's perfectly normal to quit and go do a company. And people think that's a step forward, not a step backwards. And I think Stanford remains the most sort of extreme exemplar of that entrepreneur-friendly ethos. But I think it's important just to keep in mind, it sort of became like that because of the tech around it and the startups around it. It didn't, I don't think, create the ecosystem. What was special about Silicon Valley for most of the period under discussion is that people would graduate from great technology universities like Carnegie Mellon, and they would, get a drive-away car together, and they would, cross the country and go to Stanford and Palo Alto and hang out there and do their company. So there was something about Silicon Valley separate from the engineering university that attracted the engineers from other universities.
Yeah, so there goes the simplistic explanations then of Stanford and the defense industry, which many people like to trot out. Now, you did mention Google, and it does seem like there's a few pivotal companies that sort of enter the imagination here. One is Apple, which seemed to have been quite influential in how VC developed. Another is Google. And you mentioned earlier Fairchild, I think it was, and Intel. I mean, how do some of these key companies intersect with VC?
Yeah, that's a great question. So I think it's true that you get these successful companies that then incubate lots of engineers, and those engineers may get itchy feet and leave and do other companies. And that's true. If you look at the way that Seattle has grown into its own tech hub because Microsoft and Amazon are based there, that's a good illustration of what we're talking about. I do think there's a sort of special sweet spot that happens when you get a company that kind of does well-ish, but then sort of hits a wall after, I don't know, 5 years or something, because the managers mess it up. The owners sort of take a wrong turn. Because then what you get is you get lots of ambitious engineers who've joined it, and they've been talented and skillful, which is why the company does well at first. But then it goes into this sort of frustrating, unsatisfying sideways move, and they all quit. And then you really get the Cambrian explosion of new startups. And so PayPal would be a great example where there were tons of good engineers. They had this merger between Elon Musk's X.com, which was sort of a rival to the PayPal group, which was founded by Peter Thiel and Max Levchin. And that merger caused a lot of, blood spilled on the ground, which led lots of engineers to quit and go off and do something else. And then they sold it probably too early to an acquirer. As I remember, it was eBay, and that didn't go so well. And so then a whole bunch more people left. And then you get the PayPal Mafia. You get this sort of group of people from Elon Musk to Peter Thiel to Max Levchin to Jeremy Stoppelman, who founded Yelp, and of course Reid Hoffman, who did LinkedIn and now is in his own right a sort of, absolutely top tier venture capitalist. So I think, PayPal Mafia would be probably the best example in the last 20 years of how a company that starts strong and then goes sideways can be influential. Earlier, it was Fairchild. which was the one that Arthur Rock backed. And because it was acquired by an East Coast parent company that refused to pay the engineers well, all the engineers quit, and they founded Intel, they founded National Semiconductor, Eugene Kleiner, who did Kleiner Perkins, came out of that group of 8 founders of Fairchild. So that was another kind of Cambrian explosion.
And one thing from what you just said, it seems like there are these phases of companies where you have the excitement phase, then you enter this sort of somewhat stodgy phase where the excitement goes, mismanagement, and so on. At the same time, you said VCs, one of the edges of VCs are how they manage risk is, having an influence, a voice on the board, and then they change management. Are there particular VC firms or individuals that really pioneered that approach of, saying, hang on, this company's not doing well, let's change management and let's even kick out the founder? When did that become something that was done?
Well, the absolute sort of avatar, or the kind of the hero of this sort of school of venture investing, or you could argue anti-hero if you're an entrepreneur who doesn't like to be fired, was Don Valentine. And Don Valentine was the founder of Sequoia. And he was a, tough guy, both mentally and physically. He had been an army water polo player. And the sheer sort of physique implied by that gave him an edge in dealing with kind of chaotic but brilliant people who might be inspired, but they might also need some reining in. He did his first successful investment in the original video game company, Atari. The culture there was so crazy, you had to go to the board meeting, which would take place where you stripped off your clothes and got in a hot tub, and there would be cans of beers, floating around in the water. And again, when Don Valentine took his shirt off to get in the water, his authority went up, not down. And later on, he did the investment in Cisco, where the 2 founders were pretty wild. I mean, one was kind of oppositional and sort of semi-catatonic, a kind of very good engineer, but hard to deal with. And the other one was kind of flamboyant and had a temper. She later allowed herself to be photographed for a magazine cover, naked, lying on the back of a horse. So she was not a sort of normal, straight up and down kind of person. And these 2 founders were brilliant, but Don Valentine did end up firing them because he thought that to turn the brilliant original Cisco router into an actual business, you needed more discipline and sort of organization in the management, and that's what he imposed.
And I mean, how did he go about doing that? Because presumably the founders would have they'd have the majority of equity and they would dominate the board, I assume. I mean, how did he go about having enough control to be able to dislodge them?
Well, the notion of founders that you can't dislodge is actually a modern invention, and that's a whole other story about how around 2005 young entrepreneurs sort of staged a revolt against the venture capital establishment, insisted on retaining more equity, and then also got super voting shares. And Google began this trend. And it was really a function of highly talented founders who, by this time, venture capital was enough of a known thing that people kind of understood the playbook. And so when they were negotiating the first check, they knew in advance that, these VCs could turn on them. And they knew the story of Don Valentine firing the founders of Cisco. And so they protected themselves by negotiating different kinds of terms that entrenched their power more, both holding more equity and having super voting shares. But back in the earlier part of the history, partly also because we're talking about, in that period, hardware companies, which are more capital intensive. So the capitalists who provide the capital have more leverage because more capital is needed to physically build the factory to make the personal computer or the chip or the router or whatever hardware we're talking about. And back in those days, the founders did not necessarily retain a majority of the stock. In fact, famously, they could be diluted down to 3% by the time the IPO came. Now, it was 3% of a big pie, so they still got rich, but they did not have a controlling stake.
Okay, that's fascinating. And now, in terms of some of the other famous names, I mean, we've talked about Sequoia, we've talked about Kleiner Perkins. How about Andreessen Horowitz? They've been around for a while now. They're one of the VC funds that tends to be very sort of public in their comments. They're opinionated as well. What's their story?
So they got started in 2009, and by this point, the venture playbook was well and truly understood. And, Mark Andreessen and Ben Horowitz had both, been around the block a few times. They'd been together at Netscape. They had done another company which had a couple of names, but Opsware and LoudCloud in the early 2000s, which they'd done together. So they'd had at least 2 iterations, and then they'd been angel investors. And so they were really seasoned in the space, and they completely understood that there is a power law return profile, not only for the startups that VCs back, there's a power law return profile also for the venture capital partnerships. And so the partnerships that can catapult themselves into the top kind of handful reap these outsized gains because they have enormous brand. Therefore, the top entrepreneurs are desperate to get those brand name VCs on their own cap table because it's sort of a signaling device. It's like people are desperate to go to an Ivy League school for college. And so they attacked the challenge of getting into venture more aggressively, with more determination to go straight into the top tier than anybody else had, I think. And they raised money really fast. They raised a lot of it. They were aggressive in the size of checks they wrote. They were aggressive in their PR strategy, as you were saying. I mean, Mark Andreessen was sort of, made for TV almost, or made for kind of public exposure kind of character, with this sort of extraordinary domed head and an ability to speak faster than anybody else in the room, and also managed to make sense at the same time as he was speaking quickly. And so they really sort of leveraged that and did push their way into the top tier very, very fast. It was helped, I think, by the fact that, they did get started in 2009 when, of course, there was an equity bull market just starting up at the same time, and specifically a technology bull market, and even more specifically, a software bull market. And Mark Andreessen famously wrote an article in the Wall Street Journal early on in the sort of trajectory of Andreessen Horowitz, saying software is eating the world. And in some sense, if you were going to be long software in the 2010s, you'd have to be really trying not to do well. And so they had the right thesis. They had these 2 high-profile experienced founders. They had a lot of ambition and determination, and they did extremely well in getting into the top tier really fast.
And you mentioned their backgrounds were they founded Netscape, so they were initially operators and startup people themselves. Is that a common trait of all of these VC firms, that they start their life as a business person, startup operators, then going to VC? Or is it the case that many of them come from the financial world, Wall Street, and then move in? You mentioned Arthur Rock was, from the Wall Street side, but later ones, what's the typical path for these guys who founded these larger VC firms?
I'd say that for most of the, period post 1970s, the typical successful VC had like 2 out of the following 3 boxes ticked. One was some sort of technical training, so an engineering degree, preferably a master's. Second was the experience of having been an operator, the one you just mentioned. And the third was, some kind of business sense, which sort of overlaps a bit with being an operator, but I mean more of a big picture, like the finance side and all that. And so the absolute classic would be the person who went to Stanford, did engineering to begin with, then was an operator, then went to Harvard Business School and got the finance side. Then they've ticked all three boxes. But I think two is plenty. And there's a bit of a myth that, that actually was fostered by Andreessen Horowitz, that, being an operator is sort of special and new and clearly better than the other things. That was kind of slightly their opening proposition, because they were both operators by background. And they had a rule at the beginning that in order to be a general partner at Andreessen Horowitz, you had to have been a former company founder yourself. And it turns out that that's neither new nor sensible. Not new because actually in the 70s, when Kleiner Perkins started, both Kleiner and Perkins were former operators. And not sensible because actually there are many other backgrounds that can be helpful to being an investor. And, some of the really successful people like Michael Moritz was actually a journalist before. You get these sort of eclectic people who turn out to be good at it. And to close yourself off from that is a mistake. So actually Andreessen Horowitz has dropped the policy it initially had of requiring general partners to have been operators themselves.
And now I did want to talk about the elephant in the room, which is also non-US elephant in the room, which is SoftBank, the Japanese company, which I don't know how you define it, what is a telecom company, investment firm, or but it really did sort of disrupt the VC space. So can you talk a bit more about what SoftBank did to Silicon Valley and the VC space?
Well, there was this sort of amazing moment, which I recreate in my book, where, I think it was 1996, Yahoo was sort of the hot internet darling in Silicon Valley. It created this directory for getting around the web. This is pre-search engines really working. And so Yahoo was everybody's gateway to the internet. So massively hot company. It had been backed by Michael Moritz of Sequoia, and it was shooting up in valuation and heading towards an IPO. And along comes this Japanese entrepreneur, Masayoshi Son, who has set up this thing called SoftBank, which is basically a retailer for software in Japan. And with amazing chutzpah, he had sort of decided he wanted to get into American internet. He bought a sort of technology publication to get himself some, introductions into the tech space in the US. And he leveraged those, and he went in to see Yahoo. And he said to the entrepreneur, Jerry Yang, I'd like to invest in your company $100 million. And that was an unheard of proposition. I mean, that nobody invested private checks of $100 million back in the 1990s. It's what today we would call a growth check, but growth had not been invented in the tech space back in 1996. And Jerry Yang's first reaction was, well, what would I do with 100 million? I don't know. I mean, I don't want that. I'm going to go public and raise money the normal way. And, I don't want that. And to which Masayoshi Son said, okay, remind me, who are your main competitors? And Yahoo had Alta Vista and a couple of the other early search engines as their competitors. And so when Jerry Yang mentioned those names, Masayoshi Son says to his sidekick, write those names down. And then he says, well, if you don't want 100 million from me, I'm going to go to Alta Vista and give it to them. Now do you want my 100 million? At this point, Jerry Yang excused himself from the meeting with his Series A venture backer, Michael Moritz. And they went off into some other room and they debated what they should do. And basically, this was a Godfather moment. This was like an offer that you can't refuse, because if you say no, your competitor gets all the capital, and then they're going to spend that on advertising. They're going to buy audience, and they're going to overtake you. So they came back into the room and said, okay, we want the 100 million. And they allowed Masayoshi Son to get in at, just pre-IPO with this enormous check. And a couple of years later, to Michael Moritz's enduring fury, it turned out that in dollar terms, not on multiple of capital invested, but in dollar terms, Masayoshi Son made way more out of Yahoo, far more dollars than Sequoia did. Sequoia had invested earlier. It had found a CEO to help out. It had kind of built the company. It had had the vision and taken the risk. And yet its profits in dollar terms were much smaller than SoftBank's. And so that was why Sequoia decided, having lived through that experience, that it was not going to let that happen again. And it set up its own growth investing business at the end of the 90s. That was one of the reasons why you get, by the time you get into sort of 2009, 2010, growth investing in tech companies becomes a big thing. IPOs get delayed until much later. The phenomenon of the unicorn, which hadn't existed in the 90s, becomes ubiquitous because rather than going public, entrepreneurs were taking these Masayoshi Son style $100 million checks and staying private.
And how would you describe the current state of the VC industry in terms of the structure of it all? Like, where are we today?
Well, what we are is we're licking our wounds from a big bust, right? The enormous run-up in valuations in the COVID period came down to earth with a bump. The public markets always correct very quickly. The private markets always correct very slowly. And so that hangover has not been cured. I was wandering around New York earlier this week, and I bumped into somebody who at first I didn't recognize because he's a friend from Silicon Valley. He's a venture investor in Silicon Valley. And so just to see him on Fifth Avenue was out of context. And I said, well, what are you doing here? He said, oh, I've taken a sabbatical for a few months. I think that tells us something about the nature of where we are in the cycle with venture. I mean, people just want time out because valuations haven't fully corrected, and it's a good time to go hang out on Fifth Avenue and do some retail therapy.
And you've obviously studied a lot of VC firms and you've met a lot of VC management and founders. I mean, how much of the success of some of the larger firms or other successful firms, however you define it, is down to luck, just being right time, right place type things, or setting up a firm, just after the GFC, and how much is skill?
Yeah, that's a really great question. And I grappled with this, especially at the beginning of my research. And I almost, didn't write the book because if I had been convinced that it's purely luck, there would have been no book to write. I mean, my objective with an investment book, whether it's More Money Than God about hedge funds or The Power Law about venture capital, is to explain to readers where the alpha comes from, right? Where is the skill? Where did the excess returns come from? And to do that through these stories of particular investors doing particular deals. And if there's actually no skill, I don't particularly want to tell a bunch of stories which are just kind of random noise. And so initially I would go out to Silicon Valley and I would say, well, what's the skill? And I would get these stories which just seem silly, all right? So you'd be told, yeah, well, the reason why Michael Moritz backed Stripe, the hugely successful payments company, is because Patrick Collison, the founder of Stripe, bonded with Michael Moritz. So great. So why did they bond? Well, you see, Patrick was a great cyclist, and when he went to see Michael, he went on his bike. What's that got to do with anything? Well, Michael also likes bicycling. When he came out of the meeting with Patrick, he saw Patrick's bike, locked up on the perimeter of the Sequoia lot, and he said, well, where do you like cycling? And they actually turned out to do some of the same cycle runs together, and Patrick's time on one of these key, Silicon Valley timed runs, the old La Honda climb, turned out to impress Mike Moritz, and so that's why they ended up. Now, come on, that is not why you create alpha. It's not some story about bros bonding over bicycles. Surely there's more than that. And it's only when you dig deeper and you're on your kind of fifth or sixth visit and you're seeing people and getting a bit under the surface that you understand that, the real story about Stripe was that, the ecosystem that Sequoia had built around it was so brilliant. Its network was so great that when a really top-notch founder like Patrick Collison had a great idea for a company, which Stripe was, the first venture capitalist who got in the door was going to be Sequoia, because they had just built that connectivity throughout the valley with a system of scouts, which now I think lots of venture partnerships do. They have these people who are on retainer to recommend deals to them, but was new at the time when this deal took place. So that was an example of how VCs entrench their network and get better deal flow. And it's a very deliberate process of creating that deal flow. And there are other stories one can tell about other investments, which look on the surface to be serendipitous and lucky. But when you understand the dynamics underneath the surface, the swan is gliding along the pond, but the legs are paddling furiously underneath. There's actually real stuff happening. And so having grappled with this, I came to the conclusion that although on the surface it can look lucky, because the nature of power law returns is like this. It says, I do this series of investments and it goes fail, 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 jackpot, fail, fail, jackpot, jackpot, fail, 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 fail. I mean, it does look like you've gone to Las Vegas and you're pulling the handle of the jukebox, whatever, the I don't gamble, but those machines
I know what
that you
you're
pull
talking
the
about.
lever. Yeah.
One-arm bandits, as it's pejoratively known.
Yeah, right, exactly. So it looks like that, but it isn't really like that. There is, manufactured serendipity in the way that the good partnerships, end up successful. And a partnership like Sequoia, which had this run from 1972 for the next 50 years, hardly putting a foot wrong. That wasn't coincidence. That was skill. And the point of my book is really to kind of get under the hood and tell the stories that explain that skill.
And in your book, you seem to suggest kind of explicitly, I would say that VCs, that ecosystem, startups, is really quite important to economic growth and the system as a whole. I mean, would you? How firm is that belief or view of yours?
It's very firm indeed. I would sort of frame this a couple of ways. One is to say that if you go back to sort of the Ronald Coase economics classics in the 1950s, and he sort of described capitalism as having two central kinds of mechanism for organizing resources, right? One is the price signal, the market, where the price signals tell you, how much things should be worth. Therefore, if their value is going up, people are going to produce more of them. And so you're allocating resources through the information in the prices. Second mechanism for organizing inputs is the corporation, where you have, you bring in the inputs, the money, the people, the talent, the network of connections. You bring it under a kind of top-down managerial structure and you direct the resources to produce stuff. And my view is that this was a great description of the 1950s, but capitalism has evolved. And now we have this middle pillar, namely venture capital and startups, where resources are allocated through a mixture of price signals and top-down direction. So a venture capitalist could be thought of a little bit like the director of the research operation in a big corporation. The VC is allocating checks to sort of technological prospectors who have an idea, they want to kind of work on it and try and develop it. And it's similar in that sense. So there's a bit of a top-down choice by the VC, which experiments, which startups to back. But then there's also a price signal because of this stage-by-stage financing, such that, when the first check into the startup runs out, there is going to be a new round of money raising and there's going to be a price for the startup. And if nobody, is willing to meet that price, the startup will go out of business. And so there's price discovery in addition to top-down direction. And so I think that's a way of thinking about why venture has become so central. It is a sort of third pillar of capitalism.
And I did want to ask for a comparison. Your earlier book was Make More Money Than God, which talked about hedge funds. So, and this is more kind of anecdotal. for that book, you interact with lots of hedge funds. For your latest book, Power Law, you interact with lots of venture capital firms. In terms of the types of people in either sector, are they similar types of people, or is it very different? I mean, how would you compare or contrast the personalities in the two areas?
Sure, I'll answer your question, but I can't resist a quick commercial, which is that I've actually written 5 books. And people talk about the power law and more money than God. But I wrote one about Alan Greenspan and central banking. I wrote one about the World Bank and development economics. I just want your listeners to be aware that, you know, there are other options for you to read if you're interested in either central banking or development economics. But to answer your question, the contrast between venture capital and hedge funds is pretty interesting. I mean, the main thing I came away with is that in hedge fund world, it's perfectly fine and possibly even good to be a bit introverted, because, you know, it's really about developing strong conviction on an unconventional position, a contrarian position, and then putting money behind it. And that's it. Once you've done your analysis and made your decision, you tell your broker to call up A&L, the investment bank or whatever, and put the position on. But the position is always there to be put on. It's not normally difficult to get, you know, the bond or equity or derivative exposure that you want. Whereas in venture capital, the position that you want to put on is actually a person, and you have to catch up in person with that individual, that entrepreneur, and persuade the entrepreneur that you will be a good partner for the next 7 years or whatever it's going to take to build a company, that you will go on the board and be a good guy or a good person, a good woman. And that's a kind of EQ skill, not an IQ skill. And so whereas in hedge fund world, you know, telling other people what your idea is a terrible idea, because then you get crowded trades and you can't exit the, you know, it becomes dangerous. And therefore, somebody like Lewis Bacon, one of the macro hedge fund managers I profiled in my book, and when I went to see him, he was this sort of insular figure behind 3 screens and, you know, hardly looked out. And people joked that when he did really well, he bought himself a private island. It made no difference because he was so insular already. In venture capital, you can't be like that. You've got to be somebody who gets energy from, you know, being in meetings with other people, either because you're sourcing the next deal and trying to persuade the entrepreneur to take your money, or because you're meeting the entrepreneurs that you backed in the last few months or the last few years. You're on their board, you're helping to counsel them through difficult decisions. Or maybe you're meeting 5 engineers who may be the hires for the startup that you backed a couple of months ago, or you're meeting people because they might be the customers of a startup that you're on the board of. It's all about meeting people. I joke that a venture capitalist is somebody who, you know, gets up in the morning, has breakfast with somebody, and then has 14 cups of coffee. We hope they are decaffeinated before they go to bed, because it's all about networking.
Yeah, no, that's great. Now you did mention some of your other books, so I have to ask you a question about Greenspan. You wrote this book, The Man Who Knew. I think you wrote the book, was it back in 2016 or so? I think it was
Correct. Yeah.
Around that time. Do you think that since you've written the book, the last, say, 7 years or so improves the standing of Greenspan from a sort of historical perspective, or has reduced his standing?
So when I wrote the book, part of the fascination was that he had already gone from hero to zero, faster than anybody else in public life that I can think of. I mean, he had been the maestro during much of his tenure as the Fed chief. And you had this great moderation in the 90s and the early 2000s, and people had Alan Greenspan, you know, portraits in their offices and sort of, you know, Alan Greenspan tea mugs and the whole thing. And so it was really a cult. And, you know, Bob Woodward's, you know, book about Greenspan published in the 90s had been called Maestro. I mean, that was literally what they called him. And so he went from maestro to being an anti-hero when in 2008 the whole financial system blew up, but he was blamed for having allowed the shadow banking system to get completely out of control, not enough regulation, and so forth. And he had left the Fed in 2006, but clearly under his leadership is when the mortgage bubble had inflated and the subprime thing had gone crazy and so forth. So part of the task that I set myself was to level set, between here and zero, there's a lot of space. What was the fair judgment? I'd say that since 2016, I'm not sure that Greenspan's reputation has changed that much, but the reputation of his tribe, namely central bankers, has clearly taken a huge hit from the resurgence of inflation. And maybe, arguably, the success that Greenspan did have as Fed chairman in getting inflation completely under control now looks more of an achievement today than it did in 2016 when I published my book. In other words, what Greenspan did is that he inherited from Paul Volcker in 1987 a Federal Reserve which had already succeeded in getting the 1970s inflation under control, but it wasn't completely under control. And indeed, it's pretty evident, inflation was going up when Greenspan took over the Fed, and the Republicans who put him in office expected him to run loose monetary policy to help them in the 1998 election and again in the 1992 election. And he refused to do the bidding of the Republican Party that had put him in office. And that's what really cemented the disinflation. And the great moderation that then follows in the 1990s is, I think, much more Greenspan's doing than people realize. People just say it's Paul Volcker. That's not true. And so that achievement, I think, looks more powerful today in light of the post-COVID inflation surge.
And that's a great point. And I do urge people to read that book. It's really, again, really well written and a great book for people in macro, which is many of our audience. Now, I did want to round off with a few personal questions. One is, what's the best investment advice you've ever received from anyone?
Well, I mean, the best is obviously the most boring, which is, how to avoid mistakes. And, I think as a sort of individual investor, if you're not a high net worth individual, the obvious things are, think about the fees you're paying and think about the taxes you're incurring. And if you can get those two things right and you're fairly diversified, that's like 99% of what you have to get right. When you're deploying more capital and you need to be more inventive and you're looking for alpha, well, I think then the most important advice is that you're trying to pick investment managers, assuming you're in that model of hiring other people, who are genuinely, truly obsessed. And here I would invoke David Swensen, the storied, leader of the Yale endowment, who died sadly recently, who really kind of got the US college endowment world into alternatives. And his mantra was, people who are really good at investing need to be somewhat unusual. They need to be really, living and breathing the specialty that they're in, whether it's merger arbitrage or, currencies or venture. And I think as an allocator anyway, it's that personality type that makes a difference, that you've got to identify that.
And some of our audience are young, relatively young, and they're leaving university soon. They're going to enter the wide world. What advice would you give such people?
I do think that investing is a terrific space to be in. It's intellectually endlessly fascinating, and it is remunerative if you do it well. And it's also, I think, gives you the opportunity to have a career that isn't necessarily inside some massive, great financial supermarket, which is highly regulated, and that can be, I think, more stultifying than maybe you realize until you do it. And so the attraction of being an investor in a smallish venture capital partnership or a small to medium-sized hedge fund I think, it gives you the flexibility to be intellectually creative and to be paid really well if you do well. So I would encourage people to think of that as a career. I didn't, as we mentioned when I began, because I really loved writing and that happened to be my special passion. And I think following your passion is the other important thing here. But if your passion happens to overlap with thinking about the world in a kind of business-oriented, probably slightly quantitative way, then I think investing is a great option.
And I see you have many books behind you, so I assume you read a lot as well. So I have to again ask you, what are some of the books that have really influenced you over your lifetime?
Well, when I was writing More Money Than God, I remember reading a book called The Money Game, which was written in the 1960s, and the author had a pseudonym, Adam Smith. And that was really a terrifically amusing kind of portrait of the money culture of the 1960s. And it opened my eyes to how you could make writing about finance both informative but also fun.
And finally, how can people get hold of your book, The Power Law, and indeed any of your other previous 4 books? And what's the best way for people to follow you in general?
So, my book's available on all the obvious online platforms, Amazon or whichever one you want. And it's available also in audio and, electronic copies. So pick your format that you prefer. In terms of getting hold of me and following me, I'm still for the moment more a Twitter person than anything else, at SC Mallaby, like Sebastian Christopher Mallaby, SC Mallaby. Who knows whether Threads would have buried Twitter in another year or so.
Right. No, that's excellent. And so I do urge everyone to buy not only your most recent book, but in fact, all of your books, especially if listeners are interested in sort of macro finance investing. These are kind of must reads, I'd say. So once again, thanks a lot, Sebastian. It's excellent having you on the podcast show. And I learned a lot by speaking to you.
Me too. I enjoyed it. Thank you for having me.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.